It's a crisis alert. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, why the Fed mulls how many rate cuts it needs to do. A major state is facing total economic collapse, and I'm going to show you why Libya, of all places, is behind it. Plus, a major European industrial superpower is also facing economic collapse. Show you why this has policymakers panicking. Plus, we have a sponsor for today's show. I'd like to welcome Cybeats Technologies back to the show. You can find them on the CSE under symbol CYBT and on the OTCQB under symbol CYBCF. And if you want to make a quick 45% return, I'm going to show you an incredible chart setup. You don't want to miss out on this because recently the NSA and DoD recommended Cybeats as part of one of their best practices report. This is a company you need to keep your eye on. Stay tuned to the end of the show or check out the pinned comment for more information. Now let's over to Bloomberg, where we picked today's story up with a headline: as Powell's pivot leaves traders debating the size and path of rate cuts. But now what we're finding out is a major state is in deep trouble. It's facing economic collapse, as we also see a major European superpower facing similar problems. We're not just going to see a couple cuts from central bankers, we're going to see a whole lot more. And while the Fed chair gave no indication on the size of cuts or the path of easing, he noted progress on inflation and said central bankers will keep a close eye on the health of the labor market as a guide for where to take policy. And this is important because when you see a state or a country start to experience an economic collapse, one thing that goes with it is the labor market. But this is something many people, including the Fed, said was not going to happen. That we're starting to see the unwind now. The only fear is how fast will it go? His words were enough to send U.S. Treasury yields and the dollar lower and stocks higher on Friday as investors perceived a green light to take on risk. But let's talk about what's happening in Libya here, because oil prices jumped nearly 3% today on Libya production halt and Israel Hezbollah attacks. And believe this is going to send the Texas economy crashing. I'm going to make the case, but something that is about to surge far more than 3%. Well, that's a stop for our sponsor today's show, Cybeats Technologies. Find them on the CSE under symbol CYBT, on the OTCQB under symbol CYBCF. You want a 45% return? Check this chart out. You see down here once, twice, three times. What happened? It popped from 11 cents where it's sitting today up to 16 cents where they're sellers. Right now, you can jump in on this. It's sitting at 11 cents. It's happened three times. Odds are strong it's going to jump there, putting money in your pocket. Again, check out the pinned comment or description for more information. As Libya's eastern government in Benghazi said Monday that oil production and exports in the North African country would shut down amid a dispute with the internationally recognized Western government in Tripoli over who should lead the central bank. Because this is sending West Texas Intermediate and Brent prices higher. But the bigger issue here is for the U.S. economy and U.S. consumers, who we already have noted cannot afford higher energy prices. This now sending gasoline prices higher, which you would think for Texas, a major energy producer, that this would be a boom for the state. But as you're about to see, it's going to send their economy crashing. And where Texas goes, well, the rest of the country will soon follow. As Texas manufacturing sector continues to experience some weakness, now turning to the regional Fed report came out today as Texas factory activity exhibited little growth in August. Now keep in mind, we've been told there was going to be a soft landing, that the economy was great shape and the slowdown was planned, but yet we're seeing absolutely no evidence. And of course, if there was a sign that higher energy prices were going to lead to an increase in demand, well, that would be in Texas, but they're not seeing that at all. And here we can see the production index, a key measure of state manufacturing conditions, inched up 3 points to 1.6, with the low reading signaling only slight growth in output from July. So absolutely no evidence of a soft landing. And most other measures of manufacturing activity continued to indicate declines this month, although they were less negative in July. Well, that's not a soft landing. The new orders index climbed 9 points to minus 4.2, which is still in contraction. The capacity utilization index pushed up 8 points to minus 2.5, also still in contraction. And the shipments index came in near zero, although that did rebound from 16.3 last month. And this is dangerous because when you start to see rising energy prices, you should see the Texas economy boom. I'm going to show you on the next chart, but there are times when rising energy prices points that we're headed into an all-out recession. That means the U.S. labor market, likely led by Texas, about to come unwound, because here we're looking at the current new orders diffusion indexes from the regional Fed survey and against crude oil prices, West Texas Intermediate. And you can see the general relationship here is that when you see new orders are rising, it's because crude oil prices are rising, and they tend to fall and rise with each other. But occasionally you see some hiccups in that. Heading into the global financial crisis, we noted that energy prices surged as oil prices rocketed up, and what happened? The Texas economy came unwound. We've seen that happen here again in recent time, just in 2022, as energy prices continued higher. That sent new orders plummeting. Again, not what you would expect, but what it's an indication here is that consumers and businesses cannot afford higher prices. That leads to a decrease in demand, and when that happens, you end up with more people on the unemployment line. Let's take a look, because talking about the labor market here in the report suggests that flat employment and slightly shorter work weeks this month. The employment index slipped to minus 0.7 with the near zero reading, indicating no change in employment levels from July. So again, you talk about the soft landing, you talk about an economic boom. We're not seeing higher energy prices lead to new orders, and when you don't see that, you do not see an increase in employment. And this is very dangerous, because if this trend continues, well, it means the layoffs are about to increase, because the evidence here is that 16% of firms noted net hiring, while 17% noted net layoffs. But here's the big one. The hours worked index remained negative, but moved up to minus 2.6 from minus 13.8. So what we're seeing here is workers getting fewer and fewer hours. While they're not losing their job just yet, when their spending power decreases, because of course that means their hours worked, their income is going down, well, that means they're spending less in the economy, and it continues to backfeed on itself. And that's why these higher energy prices from the news today out of Libya indicates that U.S. consumers are not in a position to absorb it, which means they're going to have to cut back on their discretionary spending. But let's talk further about new orders here as we continue that theme in blue against continued unemployment claims, because when you see hours get cut and demand does not follow through, well, then eventually what you start to see is people head to the unemployment line. And when we looked at Texas, we could see that very clearly as a decline in contraction in new orders, as shown by the blue line heading below that horizontal black line, leads to rising and persistent continued unemployment claims. You see that happen again around 2019 as demand came down, and you started to see that long trend of declining continued claims came to a stop. But how about here recently? What we note is around 2022, demand in Texas in terms of new orders decline, went into contraction, has largely stayed there. But look at the continued unemployment claims number. We continue to hear how that's going to head down. But based on what we're seeing in Texas, there's absolutely no sign of that at all, which suggests that their economy is on the brink of total collapse. And moderate upward pressure on prices and wages continued in August. And this is important to understand, because workers are asking and demanding higher wages, but what you see in new orders is there isn't demand. So what this means is manufacturers are getting squeezed at the margin, and eventually they're going to try to maintain those profit margins. The best way you do that, cut hours, eventually cut your low performing employees, and that just means things are only going to get worse. The wages and benefits index held steady at 22, a reading in line with historical average. But get this, raw material prices and finished good prices index pushed up 5 points. So this is dangerous, because not only are these manufacturers experiencing higher demand in terms of wage increases that they have to give out, but their input costs are going up, and they're seeing a decline in new orders. It's a perfect storm for something called stagflation, where you see the economy slow down and unemployment start to rise at a time when you can't get price growth to stop going up. It's a dangerous scenario. And that's a problem that's facing, if not just here in the U.S., but in Europe. But let's look at the new orders that came in today. This is for durable goods as we now zoom out to the national level for U.S. business equipment, which fell after a downward revision. And this is dangerous because the value of core capital goods orders, a proxy for investment equipment that exclude aircraft and military hardware, decreased 0.1% last month after a revised 0.5% gain in June. And bookings for all durable goods, those meant to last at least 3 years, jumped a whopping 9.9%. That's called the Boeing effect. Excluding transportation equipment, orders fell 0.2%. So again, this had everything to do with Boeing on that big upward print. But outside of Boeing, what do you see? Economic beliefs continuing to show up in the U.S. manufacturing base. We know this will lead to more hours getting cut, and eventually jobs will go. As we look now at manufacturers' new orders in blue, it's shown on a year-over-year rate of change against continued unemployment claims. And you can see on a national level, when you get a slowdown in new orders, well, you need fewer employees. Look at what happens. Continued claims start to rise as people lose their job and cannot find another one. That happened again in 1998, going into the dot-com bubble, again going into the global financial crisis. You look here around 2019, we saw what happened in Texas, happened on a national level as well. And now you see what's going on again at a national level is affecting the labor market. So what happens in Texas is just broadly a proxy for what we're going to see all over the country. And this is dangerous because when Texas's economy falls, well, it means everyone else will soon be behind them. And a recent Purchasing Managers survey has suggested U.S. manufacturing is struggling for momentum. Really the understatement here, as the Institute for Supply Management's manufacturing gauge earlier this month showed factory activity shrank in July by the most in 8 months, while the S&P Global Flash August PMI contracted at the fastest pace this year, indicating that all these survey reports, whether it's from the Fed or from private industry, is indicating a broad and accelerating slowdown in the manufacturing sector. All this leads to is fewer hours for the employees that do have jobs and more people hitting the unemployment line with no opportunity to re-enter the workforce to make the wage that we're used to. This is exactly the recipe and what you see when you head into a recession. Problem is, we know that our banks are largely insolvent, in particular the small and mid-sized regionals, which means we're headed into an all-out financial crisis once delinquency rates start to rise. But let's turn to Germany now, where we see muted German business confidence points to a sluggish economy. So what we see happening in Texas, what we see at the manufacturing level across the U.S. is also happening all over the world, particularly in Germany, as the IFO Institute's expectation gauge dipped to 86.8 in August from a revised 87 in the previous month. A barometer of current conditions also declined. And remember, everyone was really excited when we saw this upturn in manufacturing, and we said, look, this is probably not going to last. Watch for it to roll over. Sure enough, we're seeing it roll over, and now we're getting some indication it's going to head down, which is causing panic among policymakers. As the German economy is increasingly falling into crisis, as from the IFO president, he noted that expectations worsened in both manufacturing and services. He said they've been stuck in stagnation for some time, and this is getting worse. That's what the data is telling us. That's exactly what's happening there in Texas, and what's going to be happening all across the country here is that prices are still rising, particularly on the input level at manufacturers, at the consumer level, and we're not seeing any increase in demand. This is a worst case scenario, especially when it comes with rising unemployment. And we turn now to China, as the PBOC holds policy rates steady after warning on the bond rally. So after the Fed announces that they're likely to cut rates in September, what the PBOC should have done was cut rates, but they didn't. And I'll tell you why they didn't. Had everything to do with the yuan. They want to see money flowing back into the country, so they can't cut rates here. So they're running a very dangerous game where they're threatening to spin their entire economy into a recession in hopes that maybe the Fed cuts fast enough and money comes back home. The decision underscores Beijing's cautious approach in supporting the economy, even as China reported a rare contraction in bank loans amid weak demand. And in a debt-based economy, when you get a contraction in bank loans, well, what it means is on net, money is destroyed, because money is created in a debt-based economy when a new loan is originated, but as the principal part is paid off, or if you're not originating enough new loans to offset those that are being paid down, well, you're destroying money, and that is right along the the path of a recession. Because the PBOC has been walking a fine line of stimulating growth and cooling government bond buying spree to limit financial risk in recent months. But one company we feel that has an amazing growth potential, and that is our sponsor for today's show, Cybeats Technologies. You can find them on the CSE under symbol CYBT, on the OTCQB under symbol CYBCF. Let's talk about what's going on with Cybeats. Let's do an overview, and then we'll get into that chart where I'm going to show you how to make a quick 45% return. You need to be buying it right around 11 cents where it's at now. Look to sell at 11. But let's take a look at what's going on with Cybeats, because modern software is made up of hundreds of smaller independent software components, often sourced from different places. This process of selecting, using, and managing these components is known as the software supply chain, and is essential for creating a complete software project. Over the past year, cyber attacks have targeted the software supply chains of more than 75% of organizations, often by exploiting just one small component within the software. This has compromised the integrity of the entire product, leaving 40% of these organizations struggling to recover, often taking over a month. And these realities highlight the critical importance of Cybeats solutions, which help secure and monitor these vulnerable components to prevent such devastating impacts. And Cybeats proactively addresses this challenge by meticulously tracking and monitoring each software component. The product SBOM Studio empowers businesses with continuous vulnerability monitoring, automated risk analysis, and comprehensive regulatory compliance. This approach not only strengthens cybersecurity, but also delivers substantial cost savings by preventing problems from escalating into a full-blown crisis. And Cybeats is gaining traction, particularly in sectors where SBOM, or Software Bill of Materials compliance, is becoming mandatory. For example, the FDA now requires SBOM compliance in the medical device manufacturing industry. Similarly, industrial control systems, including power and water utilities, are subject to new EU regulations. And the esteemed customer base includes multiple industry-leading Fortune 500 companies, such as Schneider Electric. And Cybeats has near-term pipeline valued at $21 million in total contract value, and is on track to double its current revenue run rate of approximately $2.2 million by year-end 2024. And even this, Gartner predicts that by 2025, 60% of organizations procuring mission-critical software solutions will mandate SBOM disclosure, compared to just 5%, a significant growth opportunity for Cybeats. And let's take a look at some of their other highlights. They've achieved a significant year-over-year revenue increase of a whopping 693%. The National Security Agency and the U.S. Department of Defense recommended Cybeats in a best practices report, the only commercial services featured in the space. The product is fully built, operational, and having validated its approach with 100% client retention, servicing mainly U.S. and European blue chip clients. It's estimated 75% of cost saved per project at a large enterprise, and market for the SBOM is exploding due to EU and US federal regulations. And over 85% of clients who trial have bought, and the CEO was recently quoted saying the momentum will continue through the end of the year, and can we speculate a potential 693% revenue increase? It's entirely possible, but let me show you how to make money on this stock, because it's going places and you can get on the train. You know, when it gets down here into this range right around 11 cents, buyers step in. You see it happen 1, 2, and 3 times, and what happened after that? It jumped to 16 cents. That is the realization of a 45% return. As of filming right now, it's sitting at 11 cents, looking to repeat what it's already done 3 times. And you can see here, as we add on the volume profile, it's right there above the 100-day moving average. You can see very consistently where sellers are at, also where buyers are at. If it breaks above that, you can realize a potential 100% return if it jumped to that upper supply zone. But right now, focus on that initial move back to 16 cents. And you can see buyers here right underneath this at 11 cents, supporting the fact that every time the stock drops down to this level, buyers eagerly step in to take advantage, because they know it's headed up and you can jump on again on that train. Be sure to check them out on the CSE under symbol CYBT, on the OTCQB under symbol CYBCF. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.